Hedge funds are some of the most powerful financial institutions on the planet. They manage trillions of dollars, operate under extreme secrecy, and routinely pay their top managers over $1 billion a year. You cannot access this tier of Wall Street by submitting a resume on a public job board. Entering this world requires following a rigid, highly specific pipeline, starting from the university you choose, to the grueling banking bootcamp, to surviving the mathematical gauntlet of the final interview. Before you can attempt to navigate that path, you must understand exactly how their business model is designed to operate. At a foundational level, a hedge fund raises capital exclusively from high-net-worth individuals and large institutions. The objective is to deploy that money across a wide array of high-risk assets. Unlike traditional mutual funds, managers here are held to a strict, unwritten standard. They are expected to generate positive returns even if the broader market crashes. This animated breakdown illustrates how they secure their revenue. Through the standard 2 and 20 fee structure, funds take 20% of the profits and a 2% flat management fee. For a firm like Citadel managing $65 billion in capital, that 2% guarantees $1.3 billion a year in revenue before they execute a single profitable trade. That guaranteed multi-billion-dollar baseline is the precise mechanism that funds their aggressive hiring practices and allows them to pay massive starting salaries to new analysts. To justify those salaries, analysts deploy specific market strategies. The original approach is long-short equity. By buying undervalued stocks and simultaneously betting against overvalued ones, funds hedge their exposure to broad market collapses. This chart shows the mechanics of that bet, known as short selling. You borrow a share of a company like Apple from a broker, sell it immediately for $100 cash, and wait. When Apple stock drops to $80, you buy a replacement share at the lower price, return it to the broker, and pocket the $20 difference. Global macro funds take a wider view. Instead of targeting individual companies, they trade currencies, bonds, and commodities by predicting large-scale economic shifts like inflation, interest rates, and geopolitics. In 1992, high inflation made it mathematically difficult for the UK to maintain the value of the British pound. Recognizing this vulnerability, George Soros borrowed billions of pounds and immediately sold them. The immense selling pressure forced the currency's value to crash, earning Soros a $1 billion profit. Quantitative funds bypass human intuition entirely. They utilize AI algorithms and machine learning to execute millions of trades per day, exploiting micro-inefficiencies in the market faster than manual trading allows. Event-driven funds restrict their trades to corporate volatility, predicting exactly how the market will react to sudden mergers, lawsuits, or bankruptcies. An analyst candidate must internalize these approaches. In an interview, portfolio managers will expect you to pitch investments using these exact strategic frameworks. Passing those interviews require clearing strict institutional filters.
For the majority of candidates, the baseline requirement is securing admission to and graduating from an Ivy League or equivalent top-tier university. This graphic shows the two specific academic profiles funds target. You either pursue the fundamental investing route, mastering financial modeling and company valuation, or the quantitative route, acquiring a PhD in mathematics, physics, or computer science to build automated algorithms. Even with elite credentials, hedge funds rarely hire candidates directly out of undergraduate programs. You must first enter the Wall Street pipeline. This timeline illustrates the mandatory bootcamp. Candidates are expected to secure roles in investment banking or sales and trading at a major institution like Goldman Sachs or JP Morgan, surviving 80-hour work weeks for 2 to 3 years. You cannot skip this step and apply directly on a job board. The hedge fund industry is highly insular, relying almost entirely on internal referrals from these top banking divisions. To earn those referrals, candidates use their banking years to build personal trading track records or write custom algorithms, providing hard evidence that they can actively generate profit. Firm. The interview room itself is ruthless. Managers expect zero fluff. They do not care about your personal passions or hobbies. They evaluate candidates purely on their ability to assess risk and return capital. First is the conviction test. The interviewer will assign you an imaginary $100 million and require an immediate, fully detailed trade pitch. You must defend your thesis and map out your downside risk under heavy cross-examination. Next is the reaction test. If they propose a scenario where a stock suddenly drops 30% overnight, a weak candidate guesses whether to buy or sell. The correct answer is to demand more data, checking for earnings misses or fraud allegations before risking capital. The final hurdle is the probability test. Managers will present complex, abstract scenarios to see if you can evaluate financial risk mathematically. This equation demonstrates expected value. If a stock has a 20% chance of gaining 50%, a 50% chance of staying flat, and a 30% chance of dropping 40%, you multiply each outcome by its probability. This specific math results in a 10% expected value, but the baseline market average returns roughly 12% a year. When you subtract that market average from your 10% expected value, your adjusted outcome is a -2. You understand the fee structures, endure the investment banking boot camp, and train your mind to execute high-stakes probability math under intense scrutiny. It is an intentionally brutal environment where a pristine resume only buys you an introduction. Only your measurable financial results secure the job. Let me know in the comments which path you would pursue, the fundamental investor or the quantitative coder, and subscribe for more breakdowns of how money flows through the global financial system.